How's everyone doing tonight? Welcome to the Strategy Room. You are here with the banker next door, Dr. Joe Berquist, on this Saturday night, January 17th, 2026. I had to think about that for a second. Hey, so glad everyone is with me tonight. We have a great show for everyone here tonight. My gosh, I mean, talk about an incredible week. I have so much stuff to talk about. We've got Jeremy Powell being investigated over the renovations to the Federal Reserve building. We've got a major shakeup in the race for who's going to be the next head of the Federal Reserve. We've got all kinds of inflation numbers, CPI and PPI, numbers coming in less than what was expected, which is great news. We've got crypto legislation, major stall out in one of the big crypto bills called the Clarity Act, had a major stall out there. We've got some fraud in Minnesota to talk about and how that is potentially going to impact banks. We have credit cards and President Trump proposing this week to cap interest rates on credit cards. So just a major that we got all that. We got a whole bunch of other banking news and things to talk about. So just wild and crazy things. A lot of things happening yesterday and today. We're going to talk about some a little bit of tariff updates, basically news up to the minute here. Things going on with Greenland right now with the negotiations there. So we're going to talk about some of the tariff ramifications and things happening with that. Elon Musk taking Sam Altman and OpenAI to court very soon here. We're going to have a little update on that a little later. So, but some pretty crazy things. But before we jump into the numbers, I did want to say one thing that I forgot to mention last week, and that was I had sat in on a webinar with a great guy named Don Musso, who is an investment banker with a firm called FinPro in New Jersey. And I have known Don for a number of years, and Don is a wonderful guy, and has been in the banking space, investment banking for it feels like forever, but he's been around a long time. But anyway, so he did this webinar where he talked about a couple of very key things that are going to be kind of a roadmap for us, if you will, over the coming months here as we go through the rest of this month and February and March. So he basically said 2026 will be a transformative year in the banking business, looking at the economy, regulation, demographics, technological issues, talent management, and new competition as being some of the main themes of things that are going to go through as we go through the year, but some of the main themes are going to be affecting the banking industry as we go through the year. And then he talked about items that CEOs should be looking at this year. And there were a number of things in here: digital roadmap, talent management, management reviews, and succession planning. Then he talked about scenario planning, dynamic ALCO, lower rates, steeper yield curve. Then he talked about CRP, comprehensive risk platform, new strategies to grow loans and deposits, and customer segmentation. So each one of these is just a dynamite topic. I think he hit the nail right on the head. These are definitely all things that bank CEOs should be looking and thinking about this year. And we are going to go through each one of these items in the weeks and months ahead. I'll be, spending 5 minutes just talking about each one of these items because I think that they are really critical to how any bank should be out there working on their strategy, working on any plans for growth. And because again, these are all key things that play into how successful your bank either will or will not be, not only in 2026, but into the future. So all right, that being said, let's jump into our numbers here, shall we? So I always love bringing up the U.S. debt clock here. So our U.S. national debt is still cruising at $38.6 trillion. U.S. federal budget deficit is still at $1.7 trillion. Tariff revenue is now up to $371 billion. That equals out to $3,247 of revenue per taxpayer. And the debt to GDP is now at a 124.29%. Defense war spending is at $927 billion. Credit card debt is at $1.3 billion. So those are just some of our main numbers there. So not a ton of change from last week, but I still like to put that out there just to talk to everybody about that. All right, let's take a quick look at interest rates here for a second, shall we? So where is the 10-year note at? So the 10-year note is sitting at 4.227%. Now, what is interesting about this is it's something you don't normally see. So this kind of spiked up this week, and yet interest rates were lower to begin the week than they had been in a long time. I believe that the 30-year mortgage rate had got down to 6.08%, which was great because that means we were about to push into we're about to almost push back into the fives a little bit, which would be fantastic. But we're still sitting there. So the 10-year note has spiked up a little bit here at 4.227. Like I said, I still believe that will ratchet itself back down over, probably take about a month or so, maybe 6 weeks. But I do believe that will begin to come back down around 4%. But we'll see. We'll keep an eye on it. The 2-year T note, again, still hovering around 3.592%. But the 30-year bond is still going up 4.838%. So that the very long end of the curve, as they say, is steepening with that rate continuing to increase. So, all right. So let's, like I said, we'll keep those interest rates in mind. We'll come back to some of this stuff a little bit later as we go through our discussion on some of the things. But okay, our first big story of the night here. So the DOJ, Department of Justice, opens an inquiry into the Fed Chairman Jeremy Powell and what to know. So a look at the allegations, the renovations, and the implications. So what happened here? So in a January 11th video statement posted on X, Powell confirmed that 2 days prior, the U.S. Central Bank had been served with grand jury subpoenas by the Department of Justice. U.S. officials threatened a criminal indictment over Powell's Senate Banking Committee testimony in the summer of 2025 as a result of perjury allegations related to renovations of the institution's headquarters in Washington. Powell alleged that the probe is not really about the renovations or his testimony. Those are pretexts, he said. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public rather than following the preferences of the president. Trump denied any knowledge of the Justice Department's probe into the institution, turning the subject to the chair's job performance. I don't know anything about it. But he's certainly not very good at the Fed, and he's not very good at building buildings, the president told NBC News. In December of 2025, Trump teased legal action against Powell surrounding the years-long overhaul of the Fed's office building, saying that the project is way over budget. We're thinking about bringing a suit against Powell for incompetence because think of it. These aren't outstanding buildings. These are small buildings, Trump said during a news conference in Mar-a-Lago. National Economic Council Director Kevin Hassett, speaking to reporters, called the Fed building one of the most expensive buildings in the history of Washington. Yes, he's not wrong. I guess the question is, if you think the building costs $20 billion or $10 billion, do you think at some point that it's appropriate for the federal government to investigate it? If I were Fed chair, I would want them to do that. I think that it's really important to understand where the taxpayer money goes and understand why it goes this way or that. So let's get into the renovations at the heart of the matter here. So in 2017, the Federal Reserve Board approved the first comprehensive overhaul of its headquarters in the central bank's history. When the project was initially approved, the budget was $1.9 billion. The price tag has since climbed to $2.5 billion because of rising labor and material costs, asbestos and soil contamination, and extended construction timelines, according to the Federal Reserve's Office of the Inspector General in a House watchdog. Now, let's think about that in context for a minute here. I want everybody to try to keep this in mind, okay? I want you to think about football for a minute. I want you to think about football stadiums, okay? Let's think about some of the nicer, more grandiose football stadiums that have been built in the last, 5 or 6 years. Dallas Cowboys Stadium in Texas comes to mind. The Atlanta Falcons Stadium down in Atlanta comes to mind. The Minnesota Vikings Stadium in Minnesota comes to mind. The LA Rams and the LA Chargers, their joint stadium out there in California comes to mind. The 49ers new stadium comes to mind. These projects, these new football stadiums that hold 60, 70, maybe even 80,000 people. These stadiums cost 2.5 billion. They cost $2-3 billion to build these stadiums. We're talking about the Federal Reserve buildings here in DC. These are nowhere near the size of those stadiums. And they're talking about $2.5 billion for a couple of smallish buildings. It's outlandishly absurd. It's like, what are you doing with the money here? What is going on here with this money? So then just so like I said, I just wanted to put that out there just so people can kind of imagine and put this in context, okay? Because it's not just the numbers. You got to look at the size and scope of the project of what you're talking about here to understand why these numbers might be utterly ludicrous. Now, and again, I point out the fact that the FBI wanted to build a new headquarters, and Congress approved funds to build that new headquarters. Do you know how much they approved? $300 million. $300 million to build them a new headquarters. Okay, these guys got 2.5 billion. Okay, think about that for a second. I mean, it's just it's nuts. So Trump, while touring the construction site in July of 2020, estimated that the total cost was between 3.1 and 3.2 billion. This received pushback from Powell, who said the administration added the renovation of the Martin building, the primary entrance and security screening area for employees of the Federal Reserve, which was completed in 2021. In an appearance before the Senate Banking Committee in late June 2025, Powell rejected allegations that the Fed was spending lavish sums on renovation, describing the previous headquarters as not really safe. He also denied media reports of luxury upgrades. There's no VIP dining room. There's no new marble. He told lawyers there are no new, water features. There's no beehives, and there's no roof terrace gardens. Well, that turned out to all be a total lie. And obviously we have the plans for the building. All those plans are up online. You can go look at them. So that all basically turned out to be some big fibbing there on the part of Mr. Powell, excuse me. So then we get it. Obviously, you talk about the rate cut debate, monetary policy independence of the Fed, implications for the economy. But the bottom line here is that Jeremy Powell, that the Fed is in the process of building a ridiculously lavish VIP-esque building. The cost overruns have gotten to a point of absurdity. Will Mr. Powell go to jail for this? I highly doubt that. But I think there are legitimate questions here about, how money is spent. I think there are legitimate questions about the attitude of the Fed. Like in other words, there's this. There is a total lack of accountability here, right? And on the one hand, you have the Fed, who basically is, they feel like they can kind of do what they want. Don't ask us questions. Don't bother us. But at the same time, they also feel like they could take taxpayer money and spend it however they want and get whatever amount they want. And that's not right either. So there's definitely this. There's definitely this weird kind of vibe going on here about just the underlying attitudes, underlying notions about what the Fed really can or can't do. So I think those are questions. Those are hard, real questions that need to be asked and need to be examined. So, but let's continue on here. So there's a lot of other stuff here that happened with this. So then, obviously Powell resists the DOJ probe. At least 2 GOP senators and a dozen ex-Federal Reserve and Treasury officials are questioning the Trump administration's investigation of the central bank chair's testimony and renovation projects. So yes, so I will tell you something. There is nothing perhaps more exclusive than this world than being a central banker. And the central bankers, they united, baby. They united big time. They ran out to protect their boy Powell like there was no tomorrow. So look at this. Greenspan, Bernanke, Yellen, and other past officials say Trump using prosecutorial attacks to undermine the Fed. So the three amigos ride again. Jeremy Powell and Yellen, they ran out to protect their boy, man. All three of them are gonna come riding into the Fed building on horseback here on Tuesday. Oh, what a glorious sight, like the three amigos. Fantastic. But a chorus of previous Fed chairs, Treasury secretaries, and prominent economists came together Monday to support Jeremy Powell as the central bank leader faces potential perjury allegations from the Justice Department. This is how monetary policy is made in emerging markets with weak institutions with highly negative consequences for inflation and the functioning of their economies more broadly, the group said. Yeah, I mean, this is almost like comical. I mean, it really is. Global central bankers unite in defense of Fed Chairman Jeremy Powell. Global central bankers defended U.S. Federal Reserve Jeremy Powell in a joint statement Tuesday. The group included the heads of the European Central Bank and Bank of England, among others. Powell has served with integrity, focused on his mandate and an unwavering commitment to the public interest. Sure. Trump's war on the Fed threatens the global financial stability, European central bankers warn. A former ECB governor fears grave ramifications resulting from the criminal probe into Fed Chair Jeremy Powell. An obedient Federal Reserve under the control of the White House risks global financial stability. It's just like, I mean, come on, man. I mean, really, could we do much worse than the job that the Federal Reserve has been doing for the last, 15, 20 years? Can we really do worse? I mean, I'm just asking. I think that's a legit question. Citi says the future populist governments in Europe could also threaten central banks' independence. Gotta love these stories here. Trump allies and officials fear blowback from Powell probe. Senate Republicans, including Senate Majority Leader John Thune, expressed concern with Justice Department's investigation. Some Trump administration officials and allies have expressed concern that the Justice Department's criminal investigation into Federal Reserve Chair Jeremy Powell could imperil the president's nominees in the Senate and rattle financial markets. Among those alarmed about potential fallout was Treasury Secretary Scott Bessent, who called President Trump Sunday night and told him that the investing could cause several issues for the administration, according to people familiar with the matter. Bessent was worried about an impact on financial markets and hurdles during the Senate confirmation process for whomever the president selects to be the next Fed chairman once Powell's term ends in May. Bessent predictions proved prescient. Late Sunday, after the probe became public, Senator Tom Tillis, nobody cares what Tom Tillis has to say, said he would oppose any Fed nominee put forward by Trump until this legal matter is fully resolved. Tillis, who sits on the Senate Banking Committee, could block a nominee from making it to a full floor vote by siding with Democrats and opposition, given the narrow split in the panel. Even if a nominee did make it to the Senate floor, Tillis would only need a handful of other Republicans to join him and Democrats to block a nominee. Republicans have a 53-47 majority in the chamber. So, yes, there is some truth to this. I mean, there could be, Trump could run into some issues getting somebody approved. But as far as the markets go, market got this news this week and, didn't really care. Because quite honestly, to the average person on the street, it doesn't mean anything. To Wall Street and to the guys on CNBC, this is like the end of the world. This is like Armageddon. But to the average Joe on the street, they don't care. They don't care. And I think a lot of people would say, well, maybe the Fed and Jeremy Powell shouldn't have decided to build a Taj Mahal instead of just doing a nice rehab project for a couple $100 million. They went full bore and decided to blow through $2.5 billion. So, and then Powell chose to not be upfront with what was really being built over there. So I mean, that's his own fault. I mean, that's all you can say. That is his own fault. There you go. But let's go on here because I got a couple more here with this. So Powell investigation, drumbeat of Republican opposition grows on Capitol Hill. Bipartisan opposition to the opening of a criminal investigation into the Federal Reserve Chair Jeremy Powell is growing louder on Capitol Hill. Powell said Sunday that the Justice Department has launched a criminal investigation into the handling of renovations at the central bank's headquarters and his related congressional testimony. U.S. Attorney for the District of Columbia, Jean Pierro, Judge Janine, on Monday defended the investigation and downplayed that a potential indictment is coming. Republican Senator Tom Tillis vows to block Trump's Fed nominees following the probe. And then we get to Trump's investigation of Powell is also a warning to the next Fed chair. Investigation reflects lengths to which the president will go to control the central bank. You know, the criminal investigation into Fed Chair Jeremy Powell isn't ultimately about the Fed's headquarters or Powell or even interest rates. It's about power. President Trump intends to take control of the central bank no matter what the law or the courts say. In that sense, the investigation is also a message to whoever succeeds Powell, likely either Trump advisor Kevin Hassett or former Fed Governor Keith Warsh. Both claim they will be independent, but if either sets interest rates contrary to Trump's desires, they can expect the same treatment as Powell. That's a powerful incentive to stay in line. Again, I think a lot of this is overblown. A lot of this is, with Trump's going to take control of the central bank and the central bank's going to lose its independence and all this other stuff. If first of all, and I have to say this because it's blatantly obvious. I mean, the Fed has been playing politics for quite some time. You know, the Fed definitely leans a certain way that's not Republican. That I don't think that's any secret. I think everybody recognizes that. So again, this idea that I always find it laughable. This idea that the Fed does not play politics. You know, I mean, Jeremy Powell, he should have lowered interest rates sooner. He should have lowered them more than he has. And he's slow walked this whole thing. He has, been, losing money there at the Federal Reserve for the last couple of years, which I have talked about. Yes, he's reduced the balance sheet. He's also sucked all the money out of the repo market, which is causing liquidity issues in the market, which they're, of course, being very tight-lipped about. They don't want to talk too much about that right now. Jeremy Powell has not done a good job. He just has not. He has not done a good job. The business press, Bloomberg, the Wall Street Journal, they will defend him till the end of time. And they will defend the Fed till the end of time. They just nobody's allowed to beat up on the Fed. Nobody's allowed to say the obvious, that the Fed has not done a good job, that they have not helped the people out, that this is not, it's like, come on. And again, think about I want people, just because this is important, I want people to just think about the moment. Forget interest rates. Forget, just think about the moment, right? I go back to there's a reason why I show this debt clock every week. Okay. We're $38.6 trillion in debt. We have a U.S. federal budget deficit, a deficit of 1.7 trillion, right? And we had this massive spike in inflation that was caused by what? Wait for it. Oh, that's right. The Federal Reserve spending, trillions of dollars into COVID. The Federal Reserve throwing out $4 or $5 trillion during COVID, causing the massive inflation. Okay. And then Jeremy Powell hiking the interest rates that he has to beat back the inflation that he caused. And then they insulted us all by telling us all, oh, hey, don't worry. It's transitory. It's fine. Not anywhere near fine. Like, no, that's not okay. And in the midst of all that, Jeremy Powell decides that it's a good idea to spend $2.5 billion to renovate the Fed buildings. Okay. I cannot say this enough. You're not talking about new buildings here. You're talking about he spent $2.5 billion to renovate a couple of existing buildings. I mean, what? That's got to be the most expensive renovation of all time. I mean, it's unbelievable. And his again, And this just points out at how bad of a job he's done, because only somebody that is completely tone deaf would sit there and think to themselves that now, then over the last 3-4 years, that this was the moment that the Fed needed to spend $2.5 billion renovating their buildings. Okay. Only somebody who was totally out of touch and completely tone deaf would think that this was the right time to do something like that. So I just want everyone to keep that in mind and keep that in context, because that matters. That matters. It's like where is your head at, and then when you get called on the carpet on it, again, you've got politicians on both sides of the aisle. You've got the business media that immediately runs to the aid of Jeremy Powell like clockwork, runs to his aid, runs to the aid of the Fed. It basically says, "How dare you? How dare you?" Go. I wish I had the Greta Thunberg sound clip. How dare you? um, I mean, it's insulting on so many levels. On so many levels, it's like, listen, um, I don't want the Federal Reserve gone tomorrow. I don't want the Federal Reserve torn down. I'm not advocating for any of that. But this idea that, like, the Federal Reserve is beyond reproach and that they're beyond questioning, and you can't point out their ridiculous failures, and I have said for a long time that the Federal Reserve, in a very real way, is like an arsonist. They blow up your house, but then they show up with the fire truck to put out the fire, and then the media is like, oh, they showed up with the fire truck. Isn't that wonderful? Isn't that, oh, clap, clap, clap? Isn't that wonderful? They caused the fire, but they showed up with they were nice enough to show up with the fire truck to put it out. Isn't that wonderful? And again, I've talked about this a lot. I did my whole series on the Lords of Easy Money. I highly suggest, if anybody has not seen that, go see it. Go pick up a copy of the book, The Lords of Easy Money by Christopher Leonard. Go read that book. If you understand that, it's not enough to understand like what has happened the last month or the last year or the last year. You have to understand what has happened and what has transpired in the Fed for the last 50 years. You have to understand the history of what has gone on. You have to understand how badly they bungled the economy in the 1970s, that they caused the stagflation of the 1970s. You have to understand the decisions that Greenspan made in the 1990s. When Greenspan, there's two types of inflation. There's price inflation and asset inflation. So Greenspan in the 1990s, in his infinite wisdom, decided that asset inflation was perfectly fine. In other words, as long as your house goes up in value, as long as the stock market continues to climb in value, that type of inflation is great. Everybody loves that because they feel like they're getting richer. But price inflation is no good. People don't like it when the cost of stuff goes up, And what we have had over these last 5 years is massive, is both sides of the inflationary coin. We've had price and asset inflation both going up and through the roof at the same time. And like I said, people love the asset inflation. They don't like the price inflation. But Greenspan's policy in the 90s was like, hey, asset inflation, perfectly fine. Let it run, let it go. This is the roaring 90s. This is good, baby. But Greenspan also brought in the age of bubbles, okay? The dot-com bubble, the real estate bubble, all the subsequent bubbles that have formed, okay? That is on Greenspan. That's Greenspan's legacy. His is the legacy of bringing us into the bubble economy. That is what Greenspan brought us by the asset inflation. And so you have to understand all that. You have to understand all that history and understand all that context. And once you understand all that, then when you get to today and you see all this stuff, you realize how utterly absurd all this is. And you begin to look at this through a very different lens. And you begin to look at it and say, man, this is some wild, wild stuff. So, all right, so I want to go on to the Federal Reserve, the race for the next chairman here in a second. But like I said, I wanted to cover this because this is obviously the big news of the week, was that Powell was going under this investigation, and we'll have to see how this plays out. Like I said before, I don't think that Powell is getting indicted here. I don't think that he is, I don't think that he's going to jail or anything like that. But again, this is absolutely to be a nuisance, to be a thorn in his butt, to give him a wake up call that, hey man, your legacy's in danger here because of how bad of a job you have done. There you go. So that being said, all right. So, this real quick here. So we had Goolsbee, one of the Federal Reserve governors. So he was out this week basically with fear mongering again, basically running out there saying that, oh, inflation could come roaring back if the central bank independence goes away. Oh my gosh. You mean like the independence that happened when the Fed was running things? I don't know. I mean, so whether the inflation comes back, whether the Fed's there or not, does that really matter? I mean, it's like, I mean, the Fed. I mean, like I said a few minutes ago, like, can we really go wrong if the Fed? Like, I'm not saying I want that. I'm just saying that, I mean, the Fed's done such a bang up job. I mean, how could we go wrong, right? It's just, yeah, it's ridiculous, but. All right. So this was really interesting this week. So Rick Reeder, he basically sat down in an interview with the president, with Scott Bessent, a couple other people earlier this week. This was the final interview that they were going to conduct before President Trump makes his final decision as to who the next head of the Federal Reserve is going to be. So Rick Reeder discusses Fed profitability, monetary policy stability, during an interview for the chair role. So Reeder's lack of Fed and government experience viewed by officials as advantageous for leadership. I want everybody to keep that in mind for a minute here as we read through this for just a second. So BlackRock executive Rick Reeder discussed several key issues, including the profitability of the central bank, which I said has been negative. Jeremy Powell has lost over $250 billion in the last few years. Okay, yeah, people, I love how nobody talks about that. During an interview for the top job at the central bank, senior administration sources told Fox Business. Other topics discussed during the meeting with Reeder, the chief investment officer of global fixed income at BlackRock, included the importance of monetary policy stability and U.S. debt dynamics. The source said the interview was conducted in the Oval Office and included President Donald Trump, Vice President J.D. Vance, Treasury Secretary Scott Bessent, Chief of Staff Susie Wiles, and Deputy Chief of Staff Dan Scavino. So Reeder stands as the only candidate interviewed on the final list who has no Federal Reserve or government experience. People in the room viewed that as a big positive, the source says. Now, in addition to Reeder, the list of finalists include former Federal Reserve Board Governor Kevin Warsh, National Economic Council Director Kevin Hassett, and Federal Reserve Board Governor Christopher Waller. So those are the final four that are in this list. Now, the interview with Reeder is the last before the president makes his final decision. Fed Chairman Jeremy Powell's term as head of the central bank ends on May 15th. He was nominated by Trump to lead the Fed in 2017 and confirmed in 2018. The process has led the Treasury Secretary Bessent started with 10 names from a wide range of backgrounds and whittled down the prospective successors into the final list. So we've known this for a little while now, the final four. That's not really new. The president is expected to make his decision here at the end of January. Now, here is the key thing here. Fed governor in the picture right here, Stephen Miron. Now, his term is going to expire here on January 31st. Now, why is that critically important? Well, because Mr. Rick Reeder here, see, he's not on the board of the Federal Reserve right now. So he would first need to get put on the board before he could get made chair. Now, Governor Stephen Miron, he only went on as a temporary replacement. He's done on the 31st. So that means that him coming off would open the seat for Rick Reeder if they want to put him in. So that means basically February 1st, you could put Rick Reeder in there. He could get his board spot, and then they could say, yeah, now he's going to be the next chair of the Federal Reserve. That's why that timing is so key. So Fed Governor Stephen Miron terms expires January 31st, which would give the president the opening he needs. Mirren was sworn in to the role in September, filling the seat vacated by Adriana Kugler after her resignation. He has frequently called for more aggressive interest rate cuts. So now that was the first big thing of the week. And then here was the second big thing here. So Trump tells Kevin Hassett, he wants to keep him where he is. So then Kevin Warsh, the second Kevin, basically his odds jumped through the roof. And so here's Polymarket that I wanted to show everybody here for what are the odds of the next Federal Reserve chair. Kevin Warsh, his odds have shot up to 50% because of this. And this was a little shocking. I mean, this definitely took people off guard. I don't think anybody was really expecting this or Trump to do this, but President Donald Trump said he'd prefer to keep National Economic Council Director Kevin Hassett in his position as the top economic advisor, a statement that could change the dynamic in the Fed chair race. After Trump spoke, traders on prediction market site Kalshi raised their bets to a 60% chance of former Fed Governor Kevin Warsh getting the job, compared with just 16% now for Hassett. So this was a big shakeup here in the potential race here. Now, here's what I will say. So now we get back to what was it? Where was I looking for here? I was looking. So now we get back to this for a second here. So the Trump's investigation of Powell is also a warning to the next Fed chair chief. Basically, Trump allies and officials fear blowback from the Powell probe. Now, this is where this could get really interesting and where this might play out, right? So Kevin Warsh now has a 50% chance. Now, you see who moved up to number 2. Rick Reeder shot up to number 2. He went from like 1% or 2% a couple days ago. Now he's up to 18%, and he moved up into the second spot. Kevin Hassett is basically fallen out of the race. And now you have Christopher Waller is still there at 16%. Although I would say it's basically you're 50-50 now between Kevin Warsh and Rick Reeder. Now, here's the thing. I think there were a lot of, in that article we just looked at, I think there were a couple of very telling things in there. Number one, they really liked the fact that Rick Reeder he's never been on the Fed. He hasn't kind of been in the machine. They might be looking for that outsider to go in and basically shake up the Fed a little bit, which again, I like. I think that would be a good thing. I think one of the big problems at the Federal Reserve is that I do think that they have a propensity to suffer from groupthink over there at the Fed. I think if you studied the Fed a long enough time, I think a lot of people out there would concur with that there are times where the Fed is like, there's very little dissent. Everybody disagree with, whoever the chair was, whether it was Yellen or Bernanke or Powell, like whoever the chair was, there wasn't a lot of dissent there. And basically people, and that leads to, I think, a lot of groupthink at times. So you might want an outsider to basically just go in there and shake things up a little bit and basically say, hey, look, we just need to start doing things a little bit differently than they have been done here for quite a while. Now, obviously, there's a couple big things here. Kevin Warsh, he's the establishment guy. I want you to think about it like this. Kevin Warsh is the establishment guy. Okay. He's the guy. Wall Street loves Kevin Warsh. The establishment Republicans like Kevin Warsh. So they would have no problem putting him in. I don't think that Kevin Warsh would have any problem, getting through the Senate confirmation process. Rick Reeder, on the other hand, I think he would have a hard time because even though he's coming from BlackRock and even though he is a Wall Street guy, I think there are some on Wall Street that would back him. But I think that for the most part, a lot of people would look at him and say, oh, no, he's this outsider. He's going to do Trump's bidding. He's going to come in. He's going to do whatever Trump wants him to do. And this is really bad for the Fed's independence. You're going to get all this kind of fear mongering and everything out there, even though I think Rick Reeder could be a very, very interesting pick. Very interesting pick. So we'll have to see. How this plays out here over the next 2 weeks, but I think it's going to be a little bit of a wild ride with a couple of, we're going to have a couple of ups and downs here, which will be really interesting. And here's the thing with Kevin Hassett. And I just want to say this real quick because I kind of made this assessment before. I think Kevin Hassett's he seems to me like a very nice guy, like a very straightforward guy, a guy who, he's obviously doing a great job in what he's in the current role that he's serving for the president. But I think, again, what the Federal Reserve needs right now is somebody to come in and kind of kick him in the pants and kind of shake things up a little bit and get them, maybe with some fresh perspective and some fresh ideas. And was Kevin Hassett, is he the kind of guy who would strike you as the kind of guy who'd be able to go in and kind of, kick butt and take names and really, climb up, people's backs and get them going? He doesn't strike me as that kind of guy. He does not. Rick Reeder, I don't know. Maybe he is that kind of guy. Maybe he won. Maybe he won the president and the vice president and the Treasury Secretary. Maybe he won them over in that interview. Maybe he dazzled them and blew them away. Maybe he was able to say, "Hey, when I came into BlackRock and they put me in charge of all these funds or put me in charge of all this and that, I had to shake things up a little bit and I had to change things around, and maybe I had to fire a few people. Maybe I had to move a few people around. Maybe I had to do some things." Who knows? We don't know. We don't know. We don't know what he did or what he didn't say. What we do know is that whatever happened in that interview caused the president to come out and basically put Kevin Hassett on the back burner and now really alter the race here and put this in as a two-person race. So, but like I said, we'll keep an eye on this and we'll see what happens. And like I said, I think there's a lot more to come in here, and I think this is going to be a little bit of a very interesting ride here for the next couple of weeks. So, all right, let's talk credit cards here for a few minutes, shall we? So, President Trump this week, again, another big thing. Trump calls for a temporary 10% cap on credit card interest rates. The cap's proposed start date coincides with the anniversary of Trump's second term inauguration. So I don't really think that has anything to do with it. President Donald Trump said on January 9th that he would call for a one-year cap on credit card interest rates of 10%, potentially starting later this month, although its enforcement will depend on Congress. In a Truth Social post, Trump said that Americans are being ripped off by credit card companies that charge interest rates between 20 and 30%, and he vowed that his administration will put an end to it. Affordability, effective January 20th, 2026, I, as President of the United States, am calling for a one-year cap on credit card interest rates of 10%, the president wrote. The cap's proposed start date is the anniversary of Trump's second term inauguration, and if implemented, would fulfill a 2024 campaign pledge. Banking associations, including the Bank Policy Institute, issued a joint statement on January 9th, saying the 10% cap on credit card interest rates would reduce credit availability and adversely affect families and small business owners who rely on credit cards. If enacted, this cap would only drive consumers toward less regulated, more costly alternatives. We look forward to working with the administration to ensure Americans have access to the credit they need. Enforcement of the interest rate cap remains uncertain, given that the administration requires authorization from Congress to proceed. There have been some legislative efforts in Congress to pursue such a proposal, but they have yet to become law. In the post, the president did not offer explicit support to any specific bill. However, then we get this. So Trump calls Senator Elizabeth Warren. How crazy is that? After her speech on the Democratic Party's future, the Massachusetts lawmaker called for Democrats to reject the influence of the wealthy and to remain staunchly progressive, of course. But President Donald Trump and Senator Elizabeth Warren discussed affordability and interest rates in a call on January 12th, following the senator's wide-ranging address that morning about economic stances within the Democratic Party. After my speech, the president called me and I delivered this message on affordability to him directly. I told him that Congress can pass legislation to cap credit card rates if he will actually fight for it, Warren said in a statement posted on X. So again, this gets very interesting that President Trump would call Elizabeth Warren because this is something that they could actually find common ground on, and this is something that she would actually vote for to happen. But here's kind of the wild thing here with this, from a political standpoint, right? So this is a major conundrum for a lot of lawmakers out there. Well, now, why would you say that? Okay, it goes like this. The cap on credit cards would be a wildly popular thing for consumers. Okay, there's a lot of consumers out there. Let's go back to our debt clock for a moment, shall we? How much in credit card debt is out there? Oh, that's right. There's $1.3 trillion in credit card out there. How much does that equate per household? Oh, that is $8,176 per household. So that interest rate of 24, 26, 27% that you're paying on that credit card right now, that probably equates to, I would say, over $100 a month at least, maybe probably more for that $8,000 that you might be holding there on your credit cards. So, but if you cap that at 10%, that's going to dramatically drop that payment down. And then if you want to keep making the same payment, that's going to help you actually pay your credit card down faster. So again, I think for consumers out there, considering a cap on credit card interest rates is going to be a wildly popular thing for consumers. What does that mean for politicians? Well, that means that their constituents are going to want this. They're going to want this very badly. They're going to push for this. Why is that a problem for them? Well, you see, the banking lobby, they get a lot of money every year from the banking lobby. A lot of these people, a lot of the banking associations, a lot of the big banks, they give a lot of these politicians a lot of money every year to help them out. So this is one of those instances where they're calling on the politicians and they're saying, hey, do you remember all that money I gave you? Yeah, I'm cashing my chips in because I need you to make sure that this doesn't happen. Okay. But now the politicians have to go, whoa, okay, if I vote for this, if I go against this, my constituents are going to be really, really upset with me, and they are not going to be happy with me. And that goes both sides of the aisle. Not one, it goes both sides of the aisle. And I think there's a lot of people, a lot of politicians are really going to be sweating over this one because of that issue. So like I said, this really does present a conundrum from a political perspective. But let's look at just a couple quick things here, other things here with this. So Trump's credit card rate cap plan has unclear path, devastating risks, banks insiders say. So Trump proposed a 1-year 10% cap on the interest rates that American credit card companies can charge customers. Shares of Citigroup, JP Morgan Chase, Wells Fargo, Bank of America, Visa, MasterCard, American Express, and Capital One all fell in response. It's unclear, however, how the cap would be enforced. The bank industry insiders say it would have unintended consequences for consumers and the American economy. And let's look at something else here. JP Morgan CFO, card interest cap would significantly change the bank's business. The CFO of the largest U.S. lender didn't rule out that the banking industry could take legal action if a credit card interest rate cap is imposed, as President Donald Trump has suggested. So now, President Trump proposed the cap. Our belief is that actions like this will have the exact opposite consequence to what the administration wants in terms of helping consumers. Barnum told reporters before the earnings call, instead of lowering the price of credit, it will simply reduce the supply of credit, and that will be bad for everyone, consumers, the broader economy, and yes, at the margin, for us also. Barnum didn't rule out that the banking industry could take legal action if an interest rate cap is imposed. If you wind up with weakly supported directives to radically change our business that aren't justified, you have to assume that everything's on the table, the CFO said. And then let's look at this. So JP Morgan Chase says banks could fight Trump credit card rate cap. Everything is on the table. So banks and industry insiders say a proposed 10% cap on credit card interest rates would result in fewer credit card accounts for Americans and a dip in spending for the U.S. economy. And wait, do I have one more on this? Yeah, so here's another article from Investopedia. So 4/5 of credit card accounts could vanish under Trump's rate cap, experts say. So while industry reports suggest that many Americans would lose their credit cards under a 10% cap, others argue that these claims are overblown. And that gets me to my point here. Yes, these claims are overblown. This is just this is standard kind of crisis management 101, if you want to call it that. This immediately go to the fear mongering. Oh, it's Armageddon. If they cap the interest rates, this will be the end of the world. We'll stop lending to all these people. We'll cut people's credit cards off. All this, like, no, they're not. No, they're not. They're not going to stop lending. They're not going to cut anybody's credit card off, because here's the thing. This is about your market penetration. This is about your market share. They cannot start cutting people off. They cannot start reducing, because if they do, then another player, perhaps one of these upstarts out there, maybe somebody like a Chime or a PayPal, somebody is going to jump on this. Okay, that is opportunity. Okay, they put, if the rate cap goes on and they start cutting stuff, that is opportunity for other players in the market to pick up a ton of business. And do you know what happens when the big guys, when like JP Morgan and Bank of America and Wells Fargo, when they lose that business, it doesn't come back. Okay, that's the thing. It doesn't come back. Okay, they get that credit card from somebody else, and they start getting those products from somebody. They start getting similar products from somebody else. Start switching some of their business over. That's game over. That's game over. That is called, you just lost all that market share, and it's not coming back. Unless they put out wild offers to entice people back, it's not coming back. And that's why a lot of this stuff is just overblown. It's completely overblown. So, but let's go down here. And then I just want you to look at this here for a second. So this is a great chart here. Credit card rates have jumped 10% since 2014. So back in 2019, we were at 15.09%, and then it dropped down. In February of 2022, we were at 14.56%. Then obviously the Federal Reserve started increasing interest rates. So then we jumped all the way up to 20.84%. And now we're hovering at around an average of like 20.97% over here. So, and again, this is at a time where keep in mind here, the Federal Reserve has decreased interest rates. They've brought interest rates back down. We got what? At the end of 2024, they brought the rates down 75 basis points. And then at the end of 2025, they brought the interest rates back down 75 basis points. So rates have come down in the last 2 years. They've come down 150 basis points. And yet where are we at here? The rate is actually higher, not a lot, but it's slightly higher now than it was 2 years ago in 2023, actually 2.5 years ago. So, but yet the interest rates have come down, but these credit card rates haven't come down. They're still ridiculously high. So obviously they have some room that they could bring this down. I would basically say, hey, I would go back if I was them and I was negotiating and I was in a room with them. I would say to them, hey, President Trump, I'll tell you what, we'll bring the rates back down. Don't put a cap on. Don't do that. But we'll bring the rates back down to 15%. Okay, we'll meet you halfway. We'll bring it down to 15%. Okay, and then leave it that. Or maybe they can say, oh, or if he negotiates hard, maybe they say, okay, well, how about 12.5? How about we do 12.5 or 13? I think that's still a better. I think that's still a better deal for them. Come back to the table and negotiate on it. Because again, this, like I said, this is ridiculous. And the fact that rates have been reduced over the last 2 years and that these rates are still there, it's hard for them to justify this, but again, the fear mongering of like, oh my gosh, the world's going to end. It's like Chicken Little. Oh, all this credit's just going to stop. It's all going to be over. No. Stop. And then it gets into, all right, so let's look at this for a second. So a savings, okay, so a 10% APR could provide. So for those who could keep their cards after a 10% rate cap, the savings could be substantial. A household carrying the national average balance of $11,019 in credit card debt at today's 21% APR would save about $1,100 a year at 10%. There you go. The Vanderbilt Policy Accelerated said that Americans overall would lose $27 billion in rewards, cash back points, travel miles, though the average borrower would save about $3 in interest for every $1 lost in points. But the people who'd benefit most are the same ones most likely to lose access. Industry estimates suggest that most borrowers with a credit score below 740 would see their cards canceled or their limits slashed. Any cap will affect people who are revolving, carrying debt month to month, and that is primarily working class and middle class consumers. People at the top of the spectrum are typically going to be paying their balances in full. While the Vanderbilt analysts estimated 10% cap would save American consumers $100 billion annually in interest payments, they concluded such a cap would cut borrowers off scores below 600. A 15% cap, the study found, might thread the needle. The rate doesn't have to be 10% to make a difference. So there you go, the 15% cap. What did I just say a minute ago? Come back and negotiate. Say, hey, what if we cut it to 15%? The rate doesn't have to be 10% to make a difference, Russ said. It could be something that's higher, but still reasonable. That's the key word, reasonable, leading to real benefits for a lot of people. For those who lose their cards, if banking and credit union industry representatives are correct, the alternatives may be even less palatable. Payday lenders, come on, all right. All right, so like I said, I just want to go back here on this for a second here. So, when they talk about the points, okay, how many people out there are really getting points on their credit cards, okay? And do those points really do anything for you, okay? You have to accumulate a lot of points, okay, to really get anything back from them, okay? You accumulate, 50,000, 100,000 points, and you got to spend a lot of money on your credit card to accumulate those kind of points. What does that equate to? A $25 gift card? I mean, it's just, it doesn't, yeah, I mean, you've got to spend a lot of money. And for the people in the middle class, like, I don't think they're getting all that much benefit out of a lot of these points and rewards programs. It's like you said, it's the wealthier consumer, the people who want, the Chase Sapphire card and the high, points, because they're the ones flying all over the place. They're the ones spending a lot of money, but they're the ones that also can afford to pay their bill off at the end of every month. So yeah, they want those points, but they're not going to be affected by this in any way, shape, or form. It doesn't matter to them. But this idea here, where did it say the 7? Okay, so the people who benefit most are the same ones most likely to lose access. So this is the ridiculous part, okay? Nobody's losing access, okay? No, the bank is not going to cut off somebody's credit card because the government put a cap on the interest rates for a year, okay? That's not going to happen. The only time you would ever get your credit card cut off is if you weren't paying the bill. If you stop paying the bill, then yeah, they'll cut your credit card off. But this idea that because you get a cap on interest rates, that they're just going to start cutting everybody's credit cards it's ludicrous on its face. It's not going to happen. But then they say here, industry estimates suggest that most borrowers with a credit score below 740 could see their cards canceled or their limits slashed. That is absolutely preposterous. No, they would not. They absolutely would not. That is ridiculous. And then they say here that, consumers could save $100 billion annually in interest payments. Yeah, I think that's a good thing. I think people would really want that. But they concluded such a cap would cut off borrowers with score below 600. Dude, if you've got a score below $600, you're not getting a credit card anyway. Like, what do you mean it would cut off access? You're not. If you've got a score below 600, you're not. You have to work to get a credit score below 600. Okay, that's like a job to earn. You have to be so bad to get a credit score below 600. I mean, that's like I can't even tell you how hard you have to work to get you have to basically like never pay a bill on anything ever to get a credit score below 600. And these banks are, if you show up and you've got a credit score below 600, you're not getting approved for a credit card. You're not. Okay, so that's again, that's ridiculous. So I think the arguments here in this article are ridiculous, but they do point out again that people would save a lot of money with this. You know, if you've got a standard balance of $11,000 at a 21% APR, you're going to save about $1,100 a year by cutting this down to a 10% rate. And just like they said, just like I said, I think the key here is to negotiate, come back and basically say, okay, we know, let's go back to our chart for a second here. Like, we know our rate of around 20, almost 21%. We know that's a little ridiculous. So I'll tell you what, we'll bring that back down to 15 if you leave us alone. Okay. And they could do that. They absolutely could do that. Because like I just said, the interest rates have come down 150 basis points in the last 2 years. They've got room to work with. They've got a lot of room to work with. So so again, I think a lot of this argument right now that's being made is ludicrous. And you know, it's just like I said, we'll have to see what happens. My guess is that they do come back to the table to negotiate on this, but we'll see. We shall see. And then I think I got one last thing here on the credit card issue. So basically, Hassett pivots to possible trump cards amid credit card interest rate battle with banks. So Kevin Hassett told Fox Business that U.S. banks could voluntarily provide credit cards to underserved Americans. President Donald Trump called for banks to cap credit card interest rates at 10%, an idea that has been roundly rejected by industry executives and their lobbyists this week. A major credit card issuer and a bank lobbyist representing big lenders told CNBC that they haven't yet had any discussions with the administration about a Trump card concept. So, Hassett, who is director of the National Economic Council, is floating a different plan. This one more narrowly focused on consumers who don't have credit access but have the income to justify credit lines. They could potentially voluntarily provide for people who are in that sort of a sweet spot of not having financial leverage very much because they don't have access to credit, but they have enough income and stability in their lives so they're credit worthy, Hassett told Fox Business host Maria Bartiromo. One expectation is that it won't necessarily require legislation because there will be really great news. Trump cards presented for folks that are voluntarily provided by the banks. The comments could indicate that the administration is downgrading its efforts for broad changes to the card industry that would be difficult to enact and that could hit consumer spending and the economy. So I don't really know a whole lot about this whole Trump card concept or how this, you know, may or may not, how that would work or how that would play out. So I don't know. We'll have to see if that gets like fleshed out here in the next few weeks. It could be, it could be interesting because say you go to the SBA and say you say the SBA rolls out some kind of a new credit card program where they will backstop or they will guarantee a credit card for banks. So like, in other words, if a bank says, yes, I will give I'll give a credit card with a $3,000 limit to, Mary Frances over here, because her credit score is not great. Maybe she went through a divorce or something, who knows? But Mary Frances over here doesn't have a great credit score, but she's got a really good job. And so she's got the money to pay it back. But she needs some time to get her credit back in shape, but the SBA will now give, like, I don't know, a 50% guarantee on that credit card if the bank will make that credit card to Mary Frances. That could get kind of interesting. Like I said, that is something that might prove very interesting, and that might prove interesting for a lot of banks out there, because if something like that were to come about, I would like to think that there might be a lot of banks out there in the country who don't offer credit cards right now that might jump on that. They might say, that is a very interesting thing, and depending on the demographic makeup of people in our whatever market we're serving, that might make a whole lot of sense. We might have a lot of customers that fall into that bucket, and they might want to jump on that. So again, could be interesting. We'll see. We'll have to find out. All right, so that's the credit card thing. I'm gonna jump. I want to jump into the Greenland thing here for a second, but before we do that, I want to take a step back for a second because this is the time of the show where I generally like to give everybody the economic indicators for the week. And I like to talk about the episodes that I put out this week. And I like to give everybody a little bit of banking news. So, as you can see here, I brought up on the screen. I don't know why I never did this before, but I'll do it now. So I usually read off the economic indicators to everybody, but I actually have it here. So I'm just gonna put this up so everybody can actually they can see it as I read it. Give me a sec. I need some water for a second. Okay, so our economic indicators here this week. So on Tuesday, January 20th, we have the API weekly crude oil stock. On Wednesday, January 21st, we get construction spending, we get pending home sales, we get the 20-year bond auction at 1 p.m. On Thursday, January 22nd, we get continuing jobless claims, the GDP for the third quarter of 2025, initial jobless claims, core PCE price index, the Fed's preferred inflation gauge, personal spending, and then finally on Friday, January 23rd, we get the manufacturing PMI, the services PMI, Michigan consumer sentiment, and the U.S. Baker Hughes total rig count. So a lot of economic activity coming out this week. Obviously, the big one is the core PCE price index. People will really have a lot of eyes on that. And then the GDP numbers. People will really be looking for that. So, okay. Those are economic indicators, and I will just leave that up as I get into some of the other things here for a few minutes. So, what were the 5 episodes that I put out this week? So, the first episode I put out was on Monday was called As the Republic Turns. Is renewed for a second season. So, Republic First Bank was a bank that was here in the Philadelphia metro market that I had covered for, in 23 and in 24. They had this huge drama there, big boardroom drama, ended up with the bank failing in 2024 and getting taken over by a bank called Fulton Bank here again in the Pennsylvania market. Fulton, very large player. Fulton's about 36, 37 billion in asset size. Very large local player in the southeastern PA market. They bought what was basically left of Republic First Bank after they failed, and we thought that was kind of the end of it. And it became such a soap opera that I deemed it as the Republic Turns, an obvious play on what was the famous soap Days of Our Lives. Like sands through the hourglass, so are the days of our lives. I call it so as the Republic turns. But we thought that the soap opera of Republic First Bank ended with its failure and purchase by Fulton Bank. But luckily for us, it has just been renewed for a second season. The FDIC is now investigating Republic First Bank Corp board members around the failure of the bank, which cost the FDIC insurance fund an estimated $667 million. In turn, Republic First is suing Great American Insurance for $9.38 million over an alleged coverage denial. So basically, that is the Great American Insurance provided the board insurance for First Republic board members, which is very typical. It's very common and normal for a bank to have insurance for their board of directors. And what they're saying is that when the lawsuits started flying around and that everybody started fighting with each other, that they filed claims with the insurance company to cover legal bills, and basically the insurance company denied it and said no. So the bank is claiming that those unpaid legal bills contributed ultimately to its failure. So again, kind of opening up a whole new chapter here in the failure of Republic First Bank. And I'll keep an eye on this one. I'm sure there's going to be more to come on this in the weeks and months ahead. But again, the soap opera here just doesn't end. It just keeps on going. So then on Tuesday, I did an episode called "With a Multi-Billion-Dollar Fraud Uncovered in Minnesota, What does this mean for banks? So, a massive welfare fraud scheme has been uncovered in Minnesota. The amount of the fraud is estimated at 9 billion, but could end up being much higher. Many people have been implicated and investigations have begun. The US Treasury began taking actions back in December focused on money services businesses, otherwise known as MSBs. The SBA then announced a halt on 5.5 million in federal payments to Minnesota and will begin reviewing all SBA loans and PPP loans made in the state since 2020. The focus of prosecutors is around the policy called Minnesota Nice and how billions may have been siphoned through social welfare programs. The more concerning part of this story is the fact that these schemes seem to be rampant across the country and possibly in every state. There is no doubt this will come back to banks in multiple ways, and it absolutely will. I have actually a couple of articles highlighting the fact of exactly what I'm talking about there that I will go through with you guys in a few minutes. But I thought this episode, I believe, is going to prove to be incredibly prescient, meaning that I think a lot of the stuff I bring up there is going to play out. And I did not cover that episode to be political. I did not cover that episode to, maybe try to, I think a lot of people would probably see that episode and jump to a lot of conclusions right away. Oh, he's putting this out there to grab a headline. He's putting this out there to be political, or he's putting it out there to cover one side or the other or whatever. No. I'm looking at this purely through the lens of how is this going to affect banks. And I believe that this is going to come back. This is going to have a big effect on a lot of banks around the country, because I believe that this fraud is going to prove to be pervasive. I believe that these type of fraud schemes are going to be present in almost every state around the country. And this is going to affect banks in a lot of different ways. And banks are going to perhaps have different people knocking on their door. That, like, again, banks are used to having regulators knock on their door. Like they're used to having the OCC and the FDIC and the SEC. The Fed. They're used to having these people knock on their door. They know these people. They come in, they ask for somewhere. No, this is like the Treasury knocking on your door, the IRS knocking on your door. These are different government departments and government agencies coming at you, and they're going to want to look at different things. They're going to want to say, hey, do you have any customers in this business that might be wiring a lot of money, and maybe a lot of international wires? And then it might be, did you ask a lot of questions about that? Did you follow your BSA and AML policies when you were allowing them to wire money all over the place? Like there is a lot of, I think, potential risk for banks out there. And what I say in this episode is that you should be, right now is the moment that you should be very prudent. You should be looking at your depositors. You should be looking at your loans. You should be saying, like, okay, do we have any customers that could potentially fall into what they're talking about here with some of these social welfare schemes? Should we be looking at some of the daycares and some of the other things out there? Should we be paying attention to some of this stuff? So that's why I did this episode. I did this episode purely through the lens of banking and how this could potentially blow back on banks. And like I said, and I think that this could potentially come back in a number of different ways. So, but like I said, more on that later. Okay, on Wednesday, I put out an episode called Community Bank CEOs See Differentiation as their key strategic focus for 2026. So what strategies are most important to community bank CEOs going into 2026? Well, 72% of community bankers surveyed believe that their greatest opportunity lies in differentiating their bank from other financial institutions in their market. Approximately 14% are exploring new lines of business, fintech partnerships, digitization, and or wealth management and financial planning as other strategies. 50% of bankers surveyed believe they need to focus on marketing in 2026, specifically digital marketing. 59% of bankers surveyed believe that growing deposits will be their number one challenge in 2026. Of the bankers focusing on a new line of business, 17% are focusing on treasury management services. 47% of bankers surveyed believe that commercial real estate lending was going to be their primary driver of revenue in 2026. And then finally, 65% of bankers surveyed see another community bank or a credit union as their primary competitor. So this episode looked at an article from Independent Banker magazine. I love this article. I thought this article was great. I thought this delved into some really good stuff for what, bank CEOs are really looking at in 2026. And it talked about some of their key strategies, some of the key things that they're focused on at the moment. So I would highly recommend, if you want more, detail in that, go check that episode out. Then on Thursday, I did regenerative agriculture, corporate seed control, and ag lending in 2026. Now, what is interesting about this, probably about a month ago, I did an episode called The Food System is in Trouble and One Farmer Has a Plan. And again, I'm not an ag lender. I've never been an ag lender in my career. I know enough. I know a little bit about ag lending, like I know enough to be dangerous, but I know that a lot of banks in this country, ag lending is their primary focus. It's their primary method for making lending to farmers in their community. So I have put a little bit more attention on this, as particularly around things that I think are very interesting and that people would find interesting. Like, I'm learning new things myself as I'm looking into some of the things that are agricultural related. So for example, here with this, so farmers received some relief in December of 2025 when President Donald Trump unveiled a $12 billion aid package. They also received some good news when Agricultural Secretary Brooke Rollins and RFK Jr. announced a $700 million investment in what is called regenerative agriculture. So farmers reacted very positively to both announcements. Regenerative agriculture is something that farmers have been looking at for many years, and hopefully this will help to rejuvenate many farms around the U.S. Perhaps more important, though, is the corporate seed control by four major conglomerates. Their monopoly is a threat to our food system. So basically what I found out in some of this research and in the article that we covered in here is that there are four main companies that are basically control like almost all the seeds that farmers need to buy to grow their crops. And there are two companies in particular that basically have the bulk of the monopoly. And that's a real problem. That's a real problem for farmers, because farmers are almost in this, like, they're not really buying the seeds. It's almost like this, like a subscription service, which is, it's a very weird thing, but it is really hurting the farmer's ability to generate a profit. I think that is definitely something that is a major concern for our food system in general. So, and then, but beyond that, bankers need to be aware of recent sentiment in ag, and they need to provide flexible products and services. They need to manage risk, and they need to continue building relationships with their farming customers. So again, a lot of very interesting things here. I think the whole idea of regenerative agriculture is very interesting. Like, one of the things I talk about in that episode is basically how one of the things you learn about farming, right? And this is kind of like an ancillary thing with farming, right? So say, I'll give you an example real quick. So say a local developer came into me and said, "Hey, Joe, I found a nice 15-acre parcel, and I want to put up kind of a mixed use thing there. I want to put up 15 single family homes, and then I want to put up 50 townhouses." Okay. And I say, "Oh, hey, that's great. That's wonderful. Did you talk to the township?" And they say, "Oh yeah, I talked to the township. Township's happy. I got a whole architect and engineer, did a whole plot. They did a whole layout, whole land design. I got sketches, drawings. Went in, presented it to them. They loved it, gave me preliminary approval. We're going to go for final approval. That's all great." Now we get into, and I say, "Hey, do you have the land under agreement?" "Yes, I have the land under agreement with an option pending final approval." Okay. Hey, fantastic. All right. So it was a farm. What kind of a farm was it? Did they spray any chemicals on this farm? Oh, well, yes, yeah, absolutely, yeah. It was a farm actually for 100 years, and for 100 years they have sprayed all kinds of pesticides and antibiotics and all kinds of other stuff all over the farm. Ugh. Yeah, that could be a problem. Okay, then you got to immediately call up the environmental company and say, hey, we need to go out and do what's called a phase one on that farmland. I need you guys are gonna have to go around. You're gonna have to do some drilling. You're gonna take some samples. We're gonna have to run it into the lab. We're gonna have to see what those samples came back at. And almost assuredly, they're gonna come back and say, yes, we found high levels of this, this, and this. And we might have to do some level of remediation in order to basically give that property the clear that it could be used for this development. So you'd have some kind of environmental cleanup. I have seen that situation play out a lot of times, and that's why it's like important that even if you're not an ag lender, that you understand a little bit about farming and what goes on there, because it can have a major impact if you are trying to put together a certain type of project. If something new is going to be developed on that land, like, you need to understand the history of that land and what type of chemicals, what was being made there. Like, was it were they just growing wheat and corn? Do they have animals on the property? Were they growing cows and doing milk and chickens, and like what exactly was going on there, and what was being sprayed, what wasn't being sprayed? Just understanding all those factors are really important to ultimately how that's going to play out. And then you might just have knowledge, right? Like, you might just have knowledge of a particular area where you might say, maybe you've been a banker in a certain area for a long time, and somebody comes into you and says, hey, uh, you know the old Roberts estate over there on 435. Yeah, I think I want to buy that and build something on it. You might sit there and go, yeah, dude, yeah, you and 1,500 other people over the last 20 years have come in, but that property, he sprayed all kinds of nasty stuff on there. It's an environmental nightmare, and it'll cost you $500,000 to clean the property up to get that, so that you could develop it, and that the cost of cleaning it up makes it prohibitive for any type of potential project. Like I said, things like that happen. That's why, again, some of this stuff is really important to hone in on. But I've also become very interested in just the food system, if you will, because I look at the food system. Again, if you go back to that episode I did a month ago, the farmer that is quoted in that article that I cover, basically he just talks about how the economics don't work, and it's not an economics of scale. Like, in other words, it doesn't matter how big or small you are. It's the system itself doesn't work, and part of the reason why the system doesn't work is because of this seed control that I point out here in this episode. So again, I think, like I said, I like to think that some people will find this stuff very interesting, like I do. And, because, again, I think this stuff is really, really important to pay attention to. And then finally, on Friday, yesterday, the episode I put out it was a look at bank charter applications, de novo startups, IPOs, and M&A to start off 2026. So I talked about 4 different things in this episode. So there were 31 total bank charter applications filed in 2025, but most of those applications came from non-bank digital asset focused companies. Think of like PayPal, Block, those kind of things. Meanwhile, the number of de novo bank applications for 2025 was only 3. 3 total applications for 2020. I mean, that is so low, it's ridiculous. Furthermore, there were 5 U.S. bank IPOs in 2025, and that was actually the highest number in 4 years, which was 4 back 4 years ago. And then finally, bankers see a lot of potential activity and fee income in the M&A market for 2026. Now, I have talked a lot about the bank M&A market. In other words, the M&A market between banks buying other banks. The context of this episode, I talk about the M&A market from a general perspective. In other words, banks make a lot of money and fee income from putting together mergers with other companies. And then, so you have kind of the U.S. M&A market, then you have the global M&A market. But I'm just talking about the M&A market in general. In other words, what kind of fee income and revenues can banks make off of the M&A market in general? That's what I was talking about in this episode, not to be confused with just bank M&A, which I have talked about in many other episodes. So, okay, but those were the 5 episodes that I put out this week. Coming out next week, I have got some really interesting things. I've got a really good crypto episode coming out for you guys next week. I've got this Fed just put out some really interesting stuff on their balance sheet. A new research report just came out on the Fed's balance sheet. We got the whole Saks Fifth Avenue bankruptcy debacle. I'll have an episode on that this week. The unraveling of Apple's credit card partnership with Goldman Sachs, really interesting. A bank collapse in Iran that led to the tailspin of that country. I think people will, so like I said, I think I have some really good stuff in the lineup this week coming out that people I think will find really interesting. So, okay. That being said, let's go into some bank news here for a couple minutes. So the FDIC issues the third quarter state profiles. So FDIC issues its state profiles for the third quarter of 2025. New York Fed survey business activity increases in January. Mortgage rates hit the lowest level in 3 years. So the rate for the 30-year fixed rate mortgage averaged 6.06% this week, down from 6.16% the prior week. So that's fantastic. The 15-year mortgage was actually down to 5.38%. It's great. Mortgage applications decreased in December. Economic activity increases in the recent weeks, according to the Beige Book from the Federal Reserve Bank. So economic activity increased at a slight to modest pace in most Federal Reserve districts from December through early January. The producer prices was up. Retail sales rise in November. Existing home sales increase in December. We're going to talk about all 3 of those a little bit more in a few minutes. FinCEN issues frequently asked questions on Minnesota GTO. This is what I was when I talked a couple of minutes ago about that episode that I put out on, the Minnesota fraud and everything. And I said, what are the concerns of how this could blow back on banks? This is exactly what I was talking about. The Financial Crimes Enforcement Network published frequently asked questions pertaining to the recent geographic targeting order requiring all banks and money transmitters located in Hennepin County and Ramsey County, Minnesota, to file reports on certain international funds transfers of $3,000 or more. So wait a minute, what did they say there? So the geographic targeting order. So in other words, FinCEN is part of the Treasury. So the Treasury basically put out that order, and now FinCEN has to comply with that. And FinCEN is now going to go into the banks, because what did it say? It said they want to know from the banks and the money transmitters, in other words, the MSBs, the money service businesses. So, but the key word there is banks. They wanted to hear from banks as to what money was being wired internationally of $3,000 or more. So again, this is the first sign of blowback, and believe me, there's going to be more stuff beyond this. But that's exactly the kind of stuff that I was worried about. Consumer prices up in December. New home sales were down slightly in October. Not that that really matters at this point. Small business optimism edges up in December. That's great. Community banker optimism remains high. So community banker optimism dropped slightly in the fourth quarter, but remains high according to the Conference of State Bank Supervisors. Federal Reserve Bank leaders are named. So the Federal Reserve announced the chairs and deputy chairs of the 12 Federal Reserve banks for 2026. Employers added 50,000 jobs in December. Consumer sentiment edged up in early January. Senate banking delays markup of digital assets bill. We're going to talk about that in a few minutes here. So the Senate Banking Committee announced a delay in its markup of digital assets market structure legislation. In other words, crypto legislation, as ICBA continues its call for lawmakers to ensure the bill does not harm community bank lending. So like I said, we'll talk about that more. I got an article on that. We'll talk about that in a few minutes. ICBA groups voice opposition to Durbin Marshall Bill. So ICBA and other groups expressed strong opposition to recently reintroduced legislation to create new credit card routing mandates. So we'll have to keep an eye on that. CISA releases operational technology guidance. ICBA requests comment extension on OCC chartering rule. So you got that. ICBA and fintechs push for modernized CSI framework. So ICBA and the American Fintech Council encourage the federal banking agencies to modernize the framework governing confidential supervisory information. ICBA urges market structure and grassroots pushes back on credit card proposals. We talked about that from President Trump. Agencies issue 2025 Shared National Credit Program review. So credit risk for large syndicated bank loans remained moderate in 2025, according to the federal banking agencies, and trends continue to reflect the effects of borrowers' ability to manage higher interest expenses and other macroeconomic factors. So the syndicated bank loans, so I'm going to look in to actually see if I can get some more information on that, because I think there might be some good nuggets in there. The CFPB and the Justice Department withdrew the ECOA statement for non-citizens. So the Consumer Financial Protection Bureau and the Justice Department withdrew their joint statement on fair lending and credit opportunities for non-citizen borrowers. So ICBA asked courts to reverse decision on debit card interchange fee case. ICBA and other groups asked the 8th Circuit Court of Appeals to reverse a North Dakota District Court's decision holding that the Federal Reserve Board's Regulation 2 violates the Dodd-Frank Act. So, again, another thing that we'll have to keep an eye on. And then ICBA opposes Trump call to cap the credit card rate at 10%, but we already knew that. So, not much else there to go to. All right. Let's get back to the articles here, shall we? Let's see, what do we have here? Where are we at? Okay. All right, so this is big breaking news. So, President Trump has his eye on Greenland, and he wants to get going there. So Trump says 8 European nations face tariffs rising to 25% if Greenland isn't sold to the U.S. Now, this was breaking news just about 5 or 6 hours ago. This came out. So President Donald Trump said 8 NATO members U.S. imports face escalating tariffs until such time as a deal is reached for the complete and total purchase of Greenland. The tariffs will start at 10% on February 1st and shoot up to 25% on June 1st, Trump said. The tariffs target Denmark, Norway, Sweden, France, Germany, the United Kingdom, the Netherlands, and Finland, Trump wrote on Truth Social. Ambassadors from the 27-nation EU bloc will convene for an emergency meeting on Sunday. So yes, so this could get a little, I think this could get a little ugly here. And here's the interesting thing, just on a minor note here. So Denmark had control over Greenland for a long time. And then Denmark, I think it was about a year or so ago, they actually gave the control back to Greenland. But then the minute that Donald Trump started making overtures about potentially doing something, then Denmark ran right back in and basically was like, oh, wait, no, you have to talk to us. You'd have to pay us, whatever. So there is a part of me that thinks that a lot of this is show on the part of Denmark to basically get a paycheck. Okay, if Greenland's going to go to the U.S., they're just not going to let it go unless they get paid handsomely for it. So, but like I said, in the meantime, this trade war could escalate here, and that obviously is a little worrisome because this was not something. This is one of those wild card things. I was not anticipating this. I did not see this again. I thought of the tariff thing was kind of going exactly how we wanted it to go. Trump raised the tariffs. Hasn't really impacted much of anything. We've brought in a lot of revenue. It's all worked out really good. This could harm that. This could impact that at least in the short run over the next 3, 4, 5 months, because we start jacking on them. They start jacking some stuff on us. Maybe it goes back and forth. gets a little crazy. Maybe it risks blowing up some of those trade deals we had already already agreed to. So again, this is just one of those things. I mean, we're going to have to see how this plays out. But I will just add this again. I don't want to get into this, but my job here is not to get into a big, kind of political discussion on Greenland. That's not what I want to do. I just wanted to point this out more so because of the tariffs, because I've done a lot of tariff coverage here. So I thought it was important to point this out as to what was happening and how this whole thing could impact tariffs. But I just want to say one thing about Greenland, and that Greenland, if you don't understand, is incredibly strategically important for the United States. When you look at trade routes around the world and how trade routes through the North Atlantic are changing and are going to change in the next decade ahead of us. And again, that gets into economic world, right? Trade routes, supply chains, how product is moved around the world. That becomes a major economic issue. But it also becomes a national defense issue, too, because Russia and China have made a lot of overtures toward the North Atlantic. They have made a lot of overtures around, getting control of Greenland, getting control of the areas around Greenland. The U.S., bottom line, can't let that happen. We cannot let that happen, period. So again, we'll have to see how this whole thing plays out, but I think it's important to understand that aspect of it. It's important to keep that in the back of your minds. There are national security and there are economic ramifications to this for the U.S., and that's why President Trump is doing what he's doing here. So just like I said, just keep that in the back of your mind as that goes forward. So, all right. I want to keep us rolling here. So Trump wants tech companies to foot the bill for the new power plants because of AI. Yes, I agree with this. So the Trump administration and several states are urging PJM interconnection to make tech companies pay for the power needed for their data centers. They are also calling for PJM to hold an emergency auction to secure more generation. Electricity prices have exploded on PJM due in part to data centers. PJM serves more than 65 million people across 13 states and Washington, D.C. So a lot of you might be sitting out there asking yourself right now, who is PJM? PJM is the most important company that you have never heard of. PJM is actually headquartered right in my backyard here where I live. Think of PJM like if people think of like Enron, right? They are like a very small version of Enron, okay? They manage almost the entire East Coast. They manage the supply of energy on the entire East Coast. So they handle energy trading markets. So they will work with companies like Exelon, right? Like, if people remember back to Enron, what happened with Enron? How was Enron making a ton of their money? Well, they were making trades in the energy market, and they were causing, on purpose, rolling blackouts in states like California, and they were spiking the energy prices in order to make huge trading profits. And that's ultimately, and that went against them. They blew up, and the rest is history. But PJM does a lot of that same stuff. Like they work with a company called Exelon, which Exelon's interrelated with Pico, part of Pico, and Exelon is does a lot of energy trading, right? So PJM, so PJM gets the call, hey, there's a power plant. It's got 2 stacks, maybe 1 stack's running. Hey, energy demand has gone up. Turn on the other stack. Okay, and then PJM picks up the phone, calls Exelon. Hey, turn the stack on, guys. Thanks a lot. See ya. And then they conduct the flow of energy around these 13 states, all up and down the East Coast. So PJM is an incredibly important company. We literally could not live our lives on a day-to-day basis if PJM did not make sure that energy was flowing around appropriately. But PJM recently has been under a tremendous amount of pressure. PJM has been under a lot of pressure here in PA from our governor, Josh Shapiro, because they have not been moving fast enough for him on a lot of the data center projects that they're trying to bring online. And at the same time, the cost of energy has really been going up. And so PJM has been complaining to basically say, like, hey, man, look, like this stuff is coming in insanely fast. What do you want us to do? Like, we can't generate enough power to meet the demand that's out there. So what do you want us to do? So, and I think Trump here is very correct to say, again, I don't want to stop the big tech pros from doing anything. Hey, they want to have their AI and they want access to all this power and they want to build all these data centers. Have at it, guys. You go to us. I don't want my energy bill to go from, $200, $300 a month. I don't want that to go from that number up to like $900 a month, $1,000 a month, so that they can have their AI. I don't personally, as a consumer, I don't want that. So I think that this is right. I mean, hey, you guys, Meta, Microsoft, all these guys, Oracle, you guys want to build your data centers? Have at it, man. Have at it. Go build to your heart's content. But you guys are going to pay the electric bill on those bad boys, okay? I'm not. The consumers aren't going to pay. We're not going to pay we're not going to foot the bill. You want it, you're going to pay for it. So again, I'm all for that. I love it. And then we got some other things here. So White House seeking emergency power auction for nation's largest electric grid. So high-level discussions involve how to accelerate the construction of more than $15 billion in new power generation. So President Donald Trump's administration and a bipartisan mid-Atlantic group of governors teamed up on January 16th, calling for an emergency power auction and for the nation's largest grid operator to lower its prices. In the power auction, companies would bid on 15-year contracts for new electricity generation capacity, creating new power plants to meet AI-driven energy demands. The officials are urging PJM Interconnection, which handles electricity for Washington and 13 East Coast and Midwest states, to reform its policies to ensure American citizens aren't burdened with rising costs from new power plants, especially with the increasing energy demand for data centers to power artificial intelligence technology. The discussions on Friday focused on how to speed up construction of more than $15 billion in new power generation. Energy Secretary Chris Wright and Interior Secretary Doug Bergman were joined by Governors Glenn Youngkin, Mike DeWine, Josh Shapiro, and Wes Moore in signing a statement of principles at the White House events. The remaining governors from the rest of PJM service states have also signed onto the initiative. High electricity prices are a choice, Wright said in a statement. The Biden administration's forceful closures of coal and natural gas plants without reliable replacements left the United States in an energy emergency. Perhaps no region in America is more at risk than PJM. PJM outlined in an email statement to the Epoch Times its board's plan to integrate new data centers onto its grid while preserving its systems for the roughly 67 million people it serves. The plan involves 12 proposals, which PJM said includes some to be filed directly with the Federal Energy Regulation Commission and others changes the grid operator can make immediately. Some of the PJM board's proposals are significant load forecasting improvements, immediate initiation of a backdrop generation procurement process to address short-term reliability needs, an increased role for states, and a review of PJM markets. This is not a yes/no to data centers. This is a how can we do this while keeping the lights on and recognizing the impact on consumers at the same time, PJM board chairman, interim president, and CEO David Mills said in a statement. Trump declared a national energy emergency when he took office last year, warning of blackouts and soaring energy prices due to the prior administration's clean energy push. Yes. So again, this is a big deal here, big moves. And I'm trying to think, did I have another article here? Oh, that goes back to the tariff thing for a second. But again, just keeping an eye here on the energy thing. I just think that this is really, really important to keep an eye on this, because this is going to become not just this year, but for the next 5 or 10 years, this is going to become a big issue. I mean, if the big tech bros, if they are hell bent on bringing about the reality of all their stuff here, then we're going to have a lot of conversations about that and what this is ultimately going to do, because this is going to cause some big problems. And we're already seeing this, and it kind of the ramp up here, if you will, just started. So, all right. Let's take a look at a couple other things. So, Treasury Secretary says the U.S. can easily cover any tariff refunds. The Treasury currently has $774 billion, more than enough to cover refunds if the Supreme Court rules against the government. Scott Bessent said, "Yeah, I hope so, but the reality there is not very. That wouldn't be a very good one." And I would tell you this. Let's see. Let's see if we can look up on Polymarket here for a second. Let's see here. Odds of tariffs at Supreme Court. Let's see if there's anything comes up here. All right, so I'm not getting that here. I was hoping to find. I was going to get lucky. All right. Well, I had seen some things that basically. I had already seen some things that basically that the odds of Trump getting a favorable ruling on tariffs from the Supreme Court just shot up. Basically, I think the Supreme Court came to their senses and basically said, we have to uphold what he has done because it will affect any president that comes after him. That's the problem. It's that you cannot tie the president's ability to be able to negotiate tariffs with other countries, because if the president can't do it, who's going to do it? I mean, seriously, your Congress is going to do it. Congress, they can't agree on putting up a post office right now. You can't get them to agree on anything. They're shutting down the government every 5 minutes. Like what are we, it's ridiculous. Like the president has to have the ability to be able to negotiate things like that. That's just the reality of it. But like I said, we'll see what happens on that. So this was huge news. The U.S. and Taiwan reached a $500 billion chip deal. So the U.S. Consumer Secretary said he expects TSMC to double its presence in the U.S. and the industry to build out giant semiconductor industrial plants. Now, the great thing is that TSMC, they already have one major plant built here in the U.S. out in Arizona, which is already up and functioning. It's already up and operational. So now they are going to build another one, and obviously going to invest, $500 billion here. Another huge win for the Trump administration. Another huge win for America. That is chip manufacturing production coming back to the U.S., and that is phenomenal. Another really interesting thing here. So Trump to unveil plan to allowing home buyers to use 401k funds for down payments. The president will announce the final plan in Davos next week, White House economic advisor Kevin Hassett said. So the idea here is that you would be able to pull funds out of your 401k without a penalty and tax-free. And you would be able, as long as you are using that as for a down payment on a house. Now, I like this. I really like this. But I will say with a little bit of hesitation, I am usually not forever touching the money in your 401k, and that is because unless it's an absolutely like you lost your job, you can't find another one, unless you pull that money out, you're going to starve and go broke. Okay, obviously if you got a situation like that, you got to do what you got to do. But I think under normal circumstances, I am never for pulling money out of a 401k. Now, why do I say that? Because of the effect on compounding. As you start to build money in your 401k, and I think any financial advisor out there in America would back me up on this. As you start to build money in your 401k, it builds very slowly at first, but then as you start to, once you get over 100,000, it really starts to grow. Like year in and year out, it starts to compound very quickly. You'll start to see it shoot up 50,000, 80,000, 100,000. If again, provided the stock market's doing well, but you could see that go from 100,000 to what am I thinking of in the rule of 72 is basically how quickly your money will double. Look up the rule of 72 if you get a minute. It's kind of an interesting little calculation you can do to fun little calculation takes only a minute, and you can figure out like, okay, if I have $10,000 and I get this interest rate, how long will it take for my money to double? So, you think of how quickly that money compounds over time. And the problem is, the problem is, when you're younger, you got to put that money in, and you got to give yourself the time for that money to compound over time to build up to $1 million, of $1.5 million, so that you have the money in there for retirement. But if you have 200 grand in there and you take 100 grand out to go buy a house, that's going to have a severe impact on your retirement funds 20 years, 25 years down the road, because it's the difference of compounding on 200,000 versus 100,000. Look it up. I guarantee you that it's kind of like when you start saving money, like people that start saving money at 25 versus people there's a huge difference in the amount of money that people could save if you start saving at 25 versus 35, right? So and it's kind of the same kind of notion there. So like I said, usually I'm not for that. However, and there's a giant however on this one. Look, if you're 30 years old and you don't have mom or dad, like mom or dad don't have any money to give you to buy a house, and you really want to buy that house and you want to start that family, then I think that, yeah, you know what? And if you've got 100 grand or 200 grand sitting in a 401k, and you could take out 80,000 or 75 or 100 grand, and you could use that as your down payment to go buy a house, go do it. Knock yourself out. Go do it. Get in there. I think, like I said, I think this could really work. I think it could help a lot of people. So again, it could be a very interesting solution there, provided that people, like I said, are allowed to pull out the money without penalty and tax-free. If you could do that without any kind of negative hit, I think it might just work. It might help out, but we'll see what happens there. All right, as I said, so Elon Musk seeks up to $135 billion from OpenAI and Microsoft in wrongful gains. So Elon Musk is seeking up to $135 billion from OpenAI and Microsoft, saying he deserves the wrongful gains that they received from his early support, according to a court filing on Friday. So for anybody who doesn't know, Elon Musk has sued OpenAI, and he's going to court with them in April. And this is going to be blockbuster news, because I think that there is a lot of stuff that's going to come out of this. And it'll be really interesting to see how this goes. It'll be really interesting to see, if a jury does find in favor of Elon Musk, what's the penalty there? Does this jeopardize OpenAI as a business? And I think Elon does have a case here. I think he does have a very legitimate case. Without Elon Musk, there'd be no OpenAI. He provided the bulk of the seed funding, lent his reputation, and taught them all he knows about scaling a business. A preeminent expert quantified the value of that. Musk's lead trial lawyer, Stephen Molo, said in a statement to Reuters. OpenAI, in a statement, called it an unserious demand by Musk and said it was part of his harassment campaign. So again, we will see what happens with this, but I'm excited about this one. It's going to be juicy. This one's going to be good. All right, let's see here. This was interesting on a kind of a side note. GOP lawmaker moves to ban members of Congress from trading individual stocks. So Rep. Brian Still introduced the Stop Insider Trading Act. So I don't think this has a prayer in hell of passing, because there's no way that these greedy dirtbag lawmakers are going to kill their golden goose. So, but hey, good on him for putting this out there. I mean, this should pass with flying colors. Every single member in that chamber should vote for this and should make sure that none of them are trading on insider information. Like I said, it won't happen because over half of them are trading on insider information and making millions doing it. But yeah, hey, sorry, that's the cynical, uber cynical side of me coming out on that. Here's another thing that I find highly disturbing. So Facebook and Instagram parent Meta just hired U.S. Senator Dave McCormick's wife to be their president. Yes, let me say that again. Meta just hired U.S. Senator Dave McCormick's wife to be their president. Just maybe a little bit of conflict of interest there. You think maybe? So Dina Powell McCormick was appointed president and vice chairman of Meta. Mark Zuckerberg cited her finance and government experience for the role. She previously served in Trump and Bush administrations and at Goldman Sachs. Dina Powell McCormick, the wife of U.S. Senator Dave McCormick, was appointed president and vice chairman of Facebook and Instagram parent company Meta. Powell McCormick previously served in both the first Trump administration and the Bush administration and spent 16 years working at Goldman Sachs. She joined Meta's board of directors in April of last year before stepping down in December. During that time, she was heavily involved in organizing McCormick's Energy and Innovation Summit at Carnegie Mellon University and appeared on stage, which occurred in July. I find it highly, highly troubling that they would put her in there. I think that she just has major, major conflicts of interest here with her husband being a sitting U.S. senator and being a senator that is involved in all the energy initiatives and everything going on that, of course, they want to push their AI product. So, this whole thing just, it reeks. It reeks. And I would not be shocked one bit if this comes back to bite Meta right in the butt at some point, because this is ridiculous that they would even think of doing this. I mean, the look of this. I mean, I can't imagine the board meetings over there where they're like, yeah, we're going to put the wife of Senator McCormick in as our president. I mean, none of the board members were like, huh. Yeah, that might not look good, man. That might not pass the smell test. You know what I mean? And they were just like, nah, it'll be fine. Just rubber stamp. I mean, what in the world? Okay. Well, we'll see. Okay, so crypto legislation. So let's talk about this for a second here. So the Clarity Act has stalled, hitting crypto prices. And what do we all need to know? Well, the Senate Banking Committee postponed its scheduled markup of a key crypto bill this week after Coinbase CEO Brian Armstrong pulled support for its draft its draft text, rather, not next. Shares of crypto companies such as Coinbase, Circle, and Bullish declined following the news, with crypto prices giving back gains seen earlier in the week. So what they are fighting over right now is basically the ability to pay some kind of interest on crypto. So in other words, you've got a stable coin out there, and a lot of the stable coins are paying interest rate now of 3%, 4%, which obviously is a lot higher than, say, if you had your money in a savings accounts at banks still are paying next to nothing. CD rates are okay. You probably still get a lot of CDs out there at 3, maybe even hovering around 4% some places. But what banks are really worried about, and the Treasury actually put out a study earlier in 2025, which I covered in an episode, where they talked about the potential impact that if stable coins were offering interest and what that would have on bank deposits. So it's I see both sides. Like the crypto bros are over here going, well, wait a minute, we want to be able to sell our stable coins to customers, and we want to be able to pay them as some kind of interest or rewards or whatever in order to entice them to want to buy it. But the banks are going, well, no, because we don't want you to have that ability, because this could really hurt our deposits. And if you siphon our deposits off, that's going to really hurt our ability to lend, and thus will hurt the overall economy. So it is a very legitimate concern on the part of banks, but I think it's also very difficult for them to sit there and just arbitrarily try to write into the bill here that oh, sorry, crypto guys, you can't have nothing. So I don't know. So obviously this really came to a head here with Brian Armstrong from Coinbase. He ran on to CNBC and everything else. It was like, hell no, this ain't happening. No way, no how. I'm not going for this. Pfft, forget it. Um, so this is really stalled out, and we will see what happens. Now, obviously, I had talked about this is just the second of the three crypto bills. If we just go back to last year real quick and just remember, the House passed three crypto bills. They passed the Genius Act, they passed the Clarity Act, and they passed the Anti-CBDC Act. Now, the Genius Act went through the Senate, got signed by President Trump into law, and now they're working on the nuts and bolts of that regulation. As they begin to roll it out here, you had the open comments period, and now they're kind of putting that together. But I have repeatedly said, in order for us to have the full guardrails, if you will, of the crypto legislation, we need all three bills to pass. All three bills make up what I call the three-legged stool of the crypto regulation. We have to have all three of those bills pass in order to have like the full guardrails, if you will. So the Genius Act kind of lays out the premise, right? But the Clarity Act is what talks about how the whole thing is going to work. What are the inner workings of that machine, if you will, and how it's going to go. That's why the Clarity Act is so important. But we need the anti-CBDC bill to kind of polish it off, if you will, to make sure that it all, that we don't have to worry about the Federal Reserve putting out their own central bank digital currency. So that has to be stopped so that it doesn't interfere with all this other stuff going on. So like I said, so we'll keep an eye on that and see how things continue to go there. So, okay, let's talk about earnings here real quick. So this was a big week for earnings. All the big banks had earnings out this week. The big four, Bank of America, JP Morgan Chase, Wells Fargo, Citibank, Goldman Sachs, and Morgan Stanley also put out their earnings. So basically, we had B of A joined Citi and Wells in projecting a lower headcount this year. Bank of America CEO Brian Moynihan expects his bank's workforce to shrink as the lender leans into AI. Citi CEO Jane Fraser, meanwhile, said the bar is raised for working at the bank. So we'll keep an eye on that. Bank of New York profit rises, but the CEO calls pressure on the Fed counterproductive. So, okay, they were talking about that. But total fourth quarter revenue rose 7% to $5.18 billion, contributing to a record revenue of $20.08 billion for fiscal year 2025. So BNY Mellon doing very good. Oh, I think this article got out of place. So let's go through. Okay. JP Morgan Chase tops estimates as trading revenue exceeds expectations. Very good. Citigroup tops estimates on stronger net interest income, smaller loan loss provisions. Very good. Bank of America tops estimates on better than expected net interest income and equities trading. That's great. Goldman Sachs tops profit estimates as equities and asset and wealth management outperform. And then finally, we get, Morgan Stanley earnings top estimates driven by wealth management. So again, all the big banks really putting out really strong earnings this week. Everything looks pretty good. They still, have a little caution for 2026. They're saying like, yeah, we're still monitoring a few things. A few things could be up and down, could be a little bumpy. But we're keeping an eye on stuff. But overall, the earnings for this week were really good. Everything looked really strong. Lending came in good. Credit quality came in pretty good. Again, nothing really bad to really come back. Like I said, just a couple things they're keeping their eye on, but nothing to really be concerned with. So. All right, let's talk about gold and silver for just a minute. So gold hits a record of 4,600 as geopolitical risks and Fed independent fears mount. So investors rushed into gold as rising geopolitical risks and renewed doubts about Federal Reserve independence rattled markets and weakened the dollar. So gold hits an all-time high. And then silver prices are up 25%. Man, they don't have enough ads on this website. Silver prices are up 25% already in 2026. Can they keep rising? So the new year has done nothing to halt the silver price rally. I just did an episode on the whole craziness that happened in the silver market right at the end of the year on December 30th and December 31st, if you want to go check that out. The factors that drove that rally in 2025 remain in place with new geopolitical concerns in play. Investors are reallocating normal portfolio assets to silver, suggesting the surge could persist. Now, let's take a look at a chart here real quick on live silver prices today. We can see that silver is at $90.16. And look at this chart here on silver. So let's go back. Let's just look at, this is the 21st of November of last year. That's not even, that's like 2 months ago. And 2 months ago, it was at $49, and now we're up at $90. We've gone up $40 in silver in just 2 months. I mean, that's pretty crazy. That's pretty nuts. So we're seeing this price of silver and the price of gold continue to skyrocket here as we start 2026. Don't really have any reason to believe at this moment that is, again, the appreciation on gold and silver might not be as great as it was last year, but again, no reason that these two are going to come crashing back down to earth anytime soon. So, so like I said, we'll keep an eye on that. And then let's just look at some consumer things real quick. So December core consumer prices rose at a 2.6% annual rate, less than expected. So this was on the CPI. So the core consumer price index showed a seasonally adjusted 0.2% gain on a monthly basis and a 2.6% annually. Both were 0.1 percentage points below expectations. On a headline basis, the CPI posted an increase of 0.3% for the month, putting the all items annual rate at 2.7%. Both were exactly in line with the Dow Jones consensus estimate. So again, we are beginning to see inflation inch down just a little bit, easing off just a little bit, but this is exactly what we were going to see. And again, this correlates exactly with the Fed's own projections. I keep saying this time and time again. The Fed's own projections showed inflation topping out in the fourth quarter of last year and then would gradually decrease over the next 2 years, going down in 26. And by the end of 27, we would get back down to less than 2%. I also reported on the website Trueflation. If anybody's never been on the Trueflation website, I highly recommend you go check it out. But even Trueflation is saying that basic inflation on many products is now down to just below 2% at 1.9%. So again, inflation going in the right direction here. So now we looked at the CPI. Now we're looking at the PPI. The producer price index rose just 2% in November, and that was below the Dow Jones consensus for a 0.3% gain. Though 0.1 of a percentage point higher than October. But on the consumer side, retail sales rose 0.6 for November. Economists had been looking for an increase of 0.4%. Excluding autos, sales were up 0.5% compared with the 0.3% estimate. So retail sales coming in really good. PPI coming in below expectations. So again, really good inflation numbers. CPI and PPI this week, fantastic. Loved to see it. I'm going to skip through the inflation breakdown for right now. I'll come back to it again. Banks are saying that the consumers remain resilient despite economic pressures. Executives warned Trump's effort to address affordability with the 10% cap on interest rates. Yeah, we talked about that earlier. But basically, bank earnings were great. Retail sales stayed up. And then, so basically, the consumer is hanging in there. The consumer's hanging for the moment. So we haven't seen this breaking there. Existing home sales ended 2025 with a strong beat as prices eased further. So there were 1.18 million units available for sale at the end of December, and that was down 18% from November. The median price of a home sold in December was $405,400, up 0.4% from a year earlier. There were a little over 4 million existing home sales for the full year, unchanged from 2024. December sales were the strongest in nearly 3 years after adjusting for seasonal factors. I think that's the important thing you got to look at there. Again, from the Wall Street Journal, home sales in December jumped 5.1%, the biggest gain in nearly 2 years. Easing mortgage rates and slower growth in home prices boosted sales to the highest level since February of 2023. And we can see from the chart here, big boost going from November to December, 4.35 million coming in here December of 2025. So again, really, really good year-end finish here in home sales. So which was a bright spot. Really good thing to see here. Very good for the real estate market. Mortgage refinance demand surges 40% higher after Trump posts briefly tanks interest rates. So for the whole week, average contract interest rates for 30-year fixed rate mortgages decreased to 6.18%. Applications for a mortgage to purchase a home increased 16% for the week and were 13% higher than the same week 1 year ago. Mortgage rates moved slightly higher to start this week. But again, great to see, mortgage refinances picking up as rates are declining. Another interesting one, rent concessions are on the rise in America's Sunbelt cities. Cities like Phoenix overbuilt upscale housing when remote workers started showing up during the pandemic. Now that extra inventory means perks for renters. So you can see here, look at this chart here for just a second. Let me make this a little bit bigger here, so hopefully everybody can see this. Now, this is change in rental prices. So you can see this, how, rent really spiked up here. And this is in Phoenix and now has really kind of come back down to earth. And so we have U.S. annual rent change and then Phoenix well below that. Now, I'm just going to put this out there for the moment, and because I know everybody's thinking the same thing. We have had 2.5 million people deported. And Phoenix has certain demographic. I would believe, and again, I go back to, I got a doctorate. I know all about the scientific method. Correlation does not equate to, or correlation, those things don't always equate to each other. You have to look at, so again, could be other factors involved in there. I'm sure it is. But again, and this is just focused on the Phoenix market, but we're also seeing a declining trend. This is also the U.S. annual rent change down here. So we're also seeing the annual rent change coming down, negative 1.3% coming down. I believe that is in part a big result of that is because of the deportations, because of the people who have been sent back or have voluntarily left. That is decreasing demand. It's all supply and demand. So the demand is decreasing. Therefore, the rates are now beginning to come back down. And I have said this before, and this might be unpopular with some people out there, but it's the economic reality. Those 25 million people that came in, if they go back, our lives get better. Everything becomes cheaper. Healthcare costs come down. Auto insurance costs come down. University costs come down, rent costs come down, everything comes down, because when you brought all those people into this country, it spiked the price of everything. That's just an economic reality. Whether people like that, don't like it, it is what it is. But anyway, just wanted to point that out, that we are seeing these rent concessions, and I'm sure there will be more studies on this in the months to follow. So we'll keep an eye on that. So, all right. Now getting back to what I had reported on earlier with the episode that I had done on the fraud in Minnesota. So again, we had this article here. What was my big concern on the fraud in Minnesota? That fraud was going to metastasize and that it was going to spread out to every other state in the U.S. And my concern there was on banks. How was that going to affect banks across the country? What kind of burden is that going to put on banks? And here we go. Dr. Oz states spending Medicaid funds on illegal immigrants worse than we thought. The Centers for Medicaid and Medicare Services is withholding $300 million from California over alleged unlawful Medicaid spending. So the Centers for Medicaid and Medicare and Medicaid Services has uncovered more Medicaid funds unlawfully spent on healthcare for illegal immigrants, reaching $1.8 billion in 8 states. It's worse than we thought. Dr. Oz post on X, spending federal Medicaid funds on non-emergency health care for illegal immigrants is against the law. If states use their own money to do it, the states need to document the spending to prove that federal dollars were not used to fund the services. These states failed to provide that for this 1.8 billion. So again, I believe that this is just the tip of the iceberg. There is so much more to come on this. And then I had another thing here. So SBA investigating, wait for it, 1.2 trillion in payments as part of fraud probe. Loeffler described federal contracting fraud as probably the worst kept secret in Washington, D.C. Federal officials are reviewing approximately 1.2 trillion in payouts to root out fraudsters, according to Kelly Loeffler, administrator of the Small Business Administration. Federal contracting and the fraud that happens within it in Washington, D.C. around these programs are probably the worst kept secret in Washington, Loeffler said during an interview with American Thought Leaders host Jan Chikalecki, if I'm saying that right. She highlighted patterns of fraud affecting the government, including the widespread abuse of the SBA's 8A business development programs that offer funding for small businesses, including education and childcare organizations. That was revealed in Minnesota. It's a huge cost to the American people when the programs are defrauded. So we have a whole path. We're cracking down on that. An investigation looking back 15 years will include audits, the first in the program's 45-year history, according to the administration. So that, like I said earlier, that is going to come back to banks. Banks are going to have a burden of now I was thinking 5 years. Now they're talking 15 years. So again, and what I talked about was the difference. Like, in other words, like I said earlier, banks are used to regulators knocking on their door. They're used to the Federal Reserve and the OCC and the FDIC. They're used to these guys. They're not necessarily used to in certain regards, the SBA, the IRS, the Treasury, FinCEN. They do have dealings with all these people, but they're not necessarily used to them coming in to investigate what they've done and say, hey, you need to pry the books open and show us all this stuff that's going on and what you've done. So again, and that was my focus on the reporting on the story, not necessarily the politics or the fraud itself, but how is this going to affect banks going forward? And I think it's going to have a big effect. And I think like I said, I think it's going to metastasize. It's going to get, this fraud's going to get bigger. They're going to find out that there's at least a little bit of this in every state. And pretty much, I think there are going to be thousands of banks across the country. They're going to get a knock on their door and they say, hey, what's going on with this? You guys need to look at this a little bit and get back to us. But all right, I got a couple more articles here for everybody so we can finish up here tonight. So M&A in 2026 may put more distance between big and small banks. Expect the acceleration in bank M&A to pick up further, especially in advance of this year's midterm elections. So again, big banks thinking here that we're going to have a pickup in M&A. But before we do that, what do we have here? Just a couple little things. M&T Bank says no banks for sale in its markets. M&A will come our way when it happens. M&T Bank Corp CFO Daryl Bibble said during an earnings conference call, citing an absence of willing sellers in its markets, mostly in the northeast of the U.S. The bank has been upfront about its desire for additional bank acquisitions to build scale and density in its footprint, but has not found any sellers. Now, I had talked about this in a bank M&A episode that I just did a couple weeks ago. If you want to go back and check that out, I talked about how a lot of the regional banks, super regional banks, just they want to buy, but there's just not a lot of sellers out there. And then also, I thought this was kind of interesting. This was a lot of bravado here by the CEO of PNC Bank. So we're coming to your market. PNC flexes muscle as a national bank. So PNC Chairman and CEO William Demchak said warning shots to regional banks on the company's fourth quarter 2025 earnings call. We're coming into your market. If you're not coming into our market to come fight us, we're coming to your market to come fight you. And we're going to get some percentage of your market, as is JP Morgan and Bank of America, Demchek said on his earnings call. The comments came after the CEO made a distinction earlier in the call that PNC is a national bank, not a regional bank. When asked by an analyst what the difference is, he said regional banks are on the defense while national banks are playing offense. Now, I also, in that episode I talked about how the CEO of PNC Bank here said that, he wants to turn PNC, he wants to get them $1 trillion balance sheet. He wants to become one of the big 5 or 6 banks in the country. That's his goal. Right now, PNC is probably about $600 billion in assets. So he wants to basically double the size of the bank. He wants to get him up to $1.2 billion in assets. And the quickest way for him to do that is through mergers and acquisitions. So, we'll see here. But I like the bravado. I like it. I like very little John Wayne-esque. Hey man, we're coming to your market. What does John Wayne say in True Grit at the end? Fill your hands. Fill your hands. Love it. Okay, and then just a couple more articles here. Vaught concedes to CFPB funding. The CFPB's acting director requested $145 million from the Fed to carry out agency duties for the fiscal second quarter, but noted he disagreed with the judge's decision, ordering the agency to do so. Now, of course, the Fed doesn't have $145 million to give him because they've lost $250 billion in the last couple of years, so they do not have that money, which is what Vaught said at the beginning of this whole fiasco. But maybe the Fed will turn on their magic printing press and just magically create the $145 million out of thin air to magically give to them. I don't know. We'll have to see what happens with that. If I'm saying this right, I think it's pronounced Genesis Bank is winding down. The Sumitomo Mitsui Banking Corp. Digital bank is closing, according to an SMBC spokesperson, confirming employment-related filings and claims about several now former employees. So this was a digital bank, and they are basically, closing. It was a digital division of this bank, and they're basically closing up as per a WARN notice. 173 employees will be affected by the layoffs with this. So, just an interesting thing to note there. U.S. Bank to buy BTIG for $1 billion to bolster capital markets business. So BTIG has served as an equity capital markets referral partner for U.S. Bank since 2014. The two firms subsequently launched an M&A advisory referral program. So again, just something to note. Checkout.com grabs Georgia banking charter. The payments processor received conditional approval for the state's merchant acquirer limited purpose bank charter. So that's very interesting. We'll keep an eye on that one. And then finally, PNC mandates a 5-day return to office starting on May 4th. So whispers about a return to full-time office work have been stirring at PNC since CEO Bill Chemchek said in a December fireside chat that remote work hurts companies. Yes, so we'll see. So again, again, he's just following some of the other big banks. I know Citibank had a return to the office basically 5 days a week. So again, he's just kind of following the MO of some of the other banks out there and just following suit. And we're kind of seeing this, and that's just kind of where we're at right now. So, all right. I'm going to go into wrap up mode real quick, guys. I'm going to bring some stuff up here. I'm going to do my story of the week, and I'm going to get my quote of the week ready here so that I have that up. But first, before we go to the quote of the week, I just want to go to my items let me look for my banners here real quick for a second. So, okay. If you're watching the podcast on Apple Podcast or Spotify, I need reviews. Please, if you can leave me some good reviews, I would greatly appreciate it, as it greatly helps the channel, greatly helps the podcast. Please do that for me. Also, if you can, visit thebankernextdoor.com. Have a lot of good stuff on the website. Go on there, check it out. Always looking for feedback. Always looking for feedback. If you think there's something I should have on there that I don't have on there, let me know. And that leads me right into make sure you could send comments, questions, or topic recommendations to info@thebankernextdoor.com. That's how you reach me. If you want to ask me a question, I always love topic recommendations. Like I said, if there's anything on the website you think should be on there or ways to improve it, send me an email. Let me know. I'd be happy to hear the feedback. And then make sure, if you want the latest updates from me, kind of like the breaking updates on what's going on, subscribe to me on YouTube, because I put out a lot of posts on YouTube, like what are the episodes that are coming out this week? If there's any change to the schedule on Strategy Room, or what's happened, or what we're going to cover on Strategy Room for the week, make sure to subscribe on YouTube so you can get those latest posts, so you can keep up with all the latest and greatest news. Make sure to follow me on social media. I am up on Getter, True Social, and X. I will tell you, I spend the majority of my time on X if you want to follow me there. BND, just remember that Banker Next Door is on YouTube, Rumble, and all major podcast platforms. We put out new episodes every week, Monday through Friday at noon. The episodes are usually about 10 to 20 minutes in length to make them easily digestible for you. So when you just check that out, maybe you're on a lunch break or driving home or to the office, you can easily listen to them every day. So, and then remember, BND Strategy Room live stream every Saturday night here on YouTube at 8 o'clock, and hopefully looking to expand that to some of the other platforms here in the next couple of weeks. So with that was being said, that is all of my typical updates here. So, okay, so what is our story of the week? So we have this week, it is Treasury yield. So Treasury yield is the return on investment expressed as a percentage on the U.S. government's debt obligations. Looked at another way, the Treasury yield is the effective interest rate that the U.S. government pays to borrow money for different lengths of time. Treasury yields don't just influence how much the government pays to borrow and how much investors earn by buying government bonds. They also influence the interest rates that individuals and businesses pay to borrow money to buy real estate, vehicles, and equipment. Treasury yields also tell us how investors feel about the overall economy. The higher the yields on longer-term U.S. Treasuries, the more confidence investors have in the economic outlook. But high long-term yields can also be a signal of rising inflation in the future. So that's a little background information on Treasury yield for everybody there. And then finally, our quote of the week. So this comes to us from a gentleman named Thomas Buxton, and his quote is, "With ordinary talent and extraordinary perseverance, all things are attainable." I love that. Perseverance, key word there. You must have perseverance in life, without a doubt. So, all right, with that being said, I'm all done, guys. I appreciate everybody hanging out with me for a couple hours here on Saturday night. I hope everybody, hopefully you could get back to the football now, maybe catch the end of the football playoff game that was going on. Can't wait to find out. I was watching Broncos and Broncos and Bills went into overtime before I came on here, so can't wait to find out who won that game. But again, thank you for hanging out with me. I hope everybody has a great MLK Day on Monday. Enjoy the long holiday weekend here, but have a great week out there. Look for episodes this week, Monday through Friday, and be safe. And I'll see everybody again next weekend. Thank you so much. Thank you for listening, and have a great time out there. See you later.